What if you're not building wealth because you're making the wrong investing decisions? But because you're making the wrong investing decisions, you could be putting money into the market every single month and still be sabotaging your financial future without realizing it. Maybe you're chasing the hottest stock. Maybe you're constantly checking your portfolio. Maybe you're waiting for the perfect time to invest. Or maybe you're making a mistake that could cost you thousands of dollars over the years. The scary part? Most investing mistakes don't look like mistakes when you're making them. They look smart, they feel logical, and sometimes everyone around you is doing the exact same thing. Today, we're breaking down 7 investing mistakes Americans make that can keep them from building serious wealth. And mistake number 7 is especially dangerous because it has nothing to do with choosing the wrong stock. It has to do with your behavior. So let's start with,
what if the reason you aren't building the wealth you want has nothing to do with how much you're investing and everything to do with the decisions you're making behind the scenes? Just consider that for a moment. You could be funneling money into the market month after month and still be quietly sabotaging your own financial future. Maybe you're chasing the hottest stock, constantly checking your portfolio, or making a purely mechanical mistake that's going to cost you thousands down the road. Welcome to this explainer. Today, we're going to pull back the curtain and look at exactly what's going on behind our own financial choices.
You know, the truly frightening thing about these financial missteps is that they never actually look like mistakes when you're making them. In the moment, they look smart. They feel completely logical. And sometimes, literally everyone around you is doing the exact same thing, which just validates your choice. Today, we're going to break down the reality of how wealth is actually lost. It isn't just in those massive market crashes. It's lost in the quiet, everyday decisions we make.
Here is our roadmap for today. We're going to explore the wealth-building illusion, the dangers of timing and chasing trends, hidden risks and fees, the panic selling trap, the moments you become your own worst enemy, and finally, a long-term wealth strategy.
So let's start with mistake number 1. Mistake #1 thread, waiting for the perfect time to invest. There's a common question almost every new investor asks. Is now a good time to invest?
The wealth-building illusion. We have this tendency to equate a high salary with inevitable wealth, but frankly, that's an illusion. Building serious wealth requires a completely different set of muscles than simply earning a paycheck. And here's the thing. None of the mistakes we're about to cover require you to be bad at math or unintelligent. Not at all. These mistakes happen to people earning $50,000, $100,000, and $500,000 a year alike, because wealth isn't just about the gross income on your tax return. It's entirely about what you do with that money and how consistently you follow a strategic plan.
Mistake 2, chasing hot stocks. Now let's talk about one of the most tempting mistakes. You open social media, and suddenly everyone is talking about the same stock.
Timing and chasing trends. Almost every investor asks the same question. Is right now a good time to invest? When the market is up, prices just feel way too high. But when it's down, fear completely takes over. So people wait in this fruitless search for the perfect time. Let's look at the actual cost of that waiting game. Imagine investor A. They spend years waiting on the sidelines for the market to crash, just trying to find that absolute perfect entry point. Now look at investor B. They simply start with a reasonable amount and they keep investing consistently through all conditions. Fast forward a few decades and investor B has benefited immensely. Why? Because time in the market is vastly more powerful than trying to perfectly time the market. You don't need to predict every single move. You just need to not let the search for perfection stop you from getting started. And that brings us right into our next trap. Chasing trends. You open up social media and everyone is suddenly talking about the exact same tech stock that just shot up 300%. Someone is claiming it's the undeniable next big thing. Take a look at the psychological life cycle of FOMO, the fear of missing out. You buy in during step 2 because you feel left behind. But by the time a massive trend becomes obvious to the broader public, all that easy excitement is already priced in. When expectations inevitably shift in step 3, that quote-unquote unstoppable stock falls dramatically. You've abandoned your strategy just to follow the herd. Successful investors know that missing one wave doesn't mean you've missed your chance to build wealth.
Mistake #3, ignoring fees. This mistake is boring, which is exactly why so many people ignore it. Imagine you invest thousands of dollars over several decades. Even relatively small differences in fees can reduce the amount of money that ultimately stays invested and compounds. You may not notice it this year.
Hidden risks and fees. Now, let's shift our focus away from the exciting, emotional mistakes and look at the more boring, mechanical errors of investing. These are the silent killers. They slowly drain your wealth over decades without you ever even noticing. So this is the question you absolutely must ask before committing a single dollar. What does this investment cost me? Look at the fund expenses, the account fees, the trading costs, and the advisory fees. And more importantly, what are you genuinely getting in return for those costs? Keep in mind, expensive doesn't automatically mean better, but low cost doesn't automatically mean better either. The real key here is understanding the trade-off. Here is the absolutely crucial point to remember. For every single dollar that leaves your investment account in fees, that is one less dollar available to compound. Now, you might not notice it this year. You probably won't even notice it next year. But stretch that out over 20 or 30 years, those tiny percentage points turn into massive, heavy drains on your overall wealth.
And sitting right alongside those hidden fees is hidden risk, specifically what we call concentration risk. Imagine finding a company you absolutely love and you put all of your money into it. If it rises, well, you feel like a genius. But what if a competitor releases a better product or that specific sector takes a massive hit? Suddenly, your entire financial future is in jeopardy. Think about it like this. Would you rather have your entire financial future sitting on one single chair or have it securely supported by multiple chairs? Spreading your investments out across different assets doesn't magically eliminate all risk, but it does avoid taking unnecessary risk that you simply don't need to be taking.
Mistake #4, putting all your money in one place. Let's say you discover one company you absolutely love. You believe in its product, you believe in its future, and you decide to put almost all your investment money into it. At first, it feels exciting. If the stock rises, you feel like a genius.
The panic selling trap. So, what happens when the market crashes or life just throws a severe curveball your way? This is where investing becomes intensely psychological and where temporary setbacks can easily be turned into permanent disasters. Let's walk through this domino effect together. It might sound strange, but you can actually invest too aggressively. Imagine an unexpected life expense pops up. Maybe your car breaks down, or worse, you lose your job. If you have no accessible emergency savings, you hit step 3. You're forced to sell your investments just to cover the cost. If this happens during a market downturn, you have just forced a temporary decline to become a permanent, locked-in loss. Your emergency fund is your financial shock absorber. Without it, you are literally forced to destroy your own long-term wealth every single time life throws you a curveball.
Mistake 5, panic selling during market crashes. This is where investing becomes psychological. Imagine you have $100,000 invested. Then the market drops. Your account suddenly shows $80,000. You open your phone. The headlines are terrifying. People are predicting a recession. Everyone is saying the market could fall even further.
Your own worst enemy. Now here is the harsh truth. You can know every single rule we've talked about today. You can have the absolute perfect portfolio, and you can still fail. Because when the pressure is on, you become your own worst enemy. Just look at the emotional voices competing in your head during wild market swings. Greed screams at you to buy more because prices are climbing. Fear screams at you to sell everything because the market is dropping. FOMO tells you that everyone else is getting rich. Impatience constantly asks why your wealth isn't growing faster. And overconfidence whispers that you know exactly what the market is going to do tomorrow. But let's be real. Nobody knows what tomorrow's market will do. When fear and greed take the wheel, your biggest enemy isn't the stock market. It's your own reaction to it.
Mistake #6, pride. Investing without an emergency fund. Here's a mistake that sounds strange. Investing too aggressively. You might think investing every dollar is the fastest way to become wealthy. But what happens when your car breaks down or you lose your job? Mistake 7, letting emotions control your investments. And now we reach the biggest mistake. Because you can know everything we've talked about and still lose money because of one thing: your behavior. Greed says, buy more, it's going up. Fear says, sell everything.
The long-term wealth strategy. So how do we actually protect ourselves from our own worst instincts? We do it by building a framework that protects our wealth from our emotions. Because successful investing isn't about predicting the future perfectly. It's about creating a strategy that doesn't require you to be perfect in the first place. Let's quickly summarize the blueprint for true financial freedom. 1. Don't wait for perfect timing. Consistency always wins. 2. Ignore the hot stock hype. 3. Understand exactly what you're paying in fees. 4. Diversify your portfolio to manage your risk. 5. Never panic sell during a downturn. 6. Build that emergency fund to act as your shock absorber.
Mistake 7, letting emotions control your investments. And now we reach the biggest mistake. Because you can know everything we've talked about and still lose money because of one thing: your behavior. Greed says, buy more, it's going up. Fear says, sell everything.
It's crashing. Everyone else is getting rich, but nobody knows exactly what the market will do tomorrow. That's why successful investing isn't about predicting the future perfectly. It's about creating a strategy that doesn't require you to be perfect. You need rules, you need patience, you need a realistic time horizon, and you need to understand what you're actually investing in. Because the market will test you. There will be exciting periods, there will be scary periods, there will be moments when quitting feels easier than continuing. And that's when your financial plan matters most.
Control your emotions. Listen, you don't need to find the next Bitcoin. You don't need to be a Wall Street expert. You just need a simple, logical strategy that you understand, and the discipline to actually stick with it. I want you to take a moment to let the reality of this statement sink in. Wealth is rarely destroyed by one bad day. It's often destroyed by a series of emotional decisions repeated over time. But, the exact opposite is also profoundly true. Real financial freedom is built through small, disciplined decisions, repeated consistently for years. Before you make your next investment, I want you to change the question. Don't just ask, how much can I make? I want you to look at your current portfolio and ask yourself, what could go wrong? The market will inevitably test you. There will absolutely be moments when quitting feels much easier than continuing. You may have a plan for your portfolio to survive the future, but the real question is, do you have a plan for yourself?
So let's go back through the 7 mistakes. Number 1, waiting for the perfect time to invest. Number 2, chasing hot stocks and FOMO. Number 3, ignoring investment fees. Number 4, putting too much money into one investment. Number 5, panic selling during market downturns. Number 6, investing without an emergency fund. And number 7, letting emotions control your decisions. Notice something? None of these mistakes require you to be bad at math. You don't need to be unintelligent. You don't even need to have a low income. These mistakes can happen to people earning $50,000, $100,000, or even $500,000 a year. Because building wealth isn't only about how much you earn. It's also about what you do with the money you earn and how consistently you follow your strategy. Here's the truth. You don't need to predict the next Amazon. You don't need to find the next Bitcoin. You don't need to become a Wall Street expert. If this video changed the way you think about investing, subscribe to the channel, because in the next video, we're going one step further. We're going to break down how to build your first $100,000 a STAD, the exact roadmap most Americans never follow. And the first $10,000 may be the hardest part, but once you understand what happens after that, building wealth starts to look very different. I'll see you in the next video.